The Gulf region is at the center of a major energy disruption, with multiple facilities halting production amid escalating regional tensions. In QatarEnergy has paused LNG production, risking around 20% of global LNG supply from the market. China, India and other Asian nations are most exposed, with over 80% of Qatar's LNG exports bound for the region. Spot LNG prices in Asia have surged and European gas futures jumped nearly 50%. In Saudi Arabia, Aramco's RAS Tanura refinery, one of the kingdom's largest crude and refined product hubs, temporarily shut down after a drone strike induced fire. The halt impacts roughly 50,000 barrels per day. Aramco's Juaima LPG export terminal has also stopped propane and butane shipments, affecting nearly 450,000 tons per month of key fuels. In Iraqi Kurdistan, where crude flowed at around 200,000 barrels per day to Turkey's Ceyhan terminal in February, international operators have stopped production as a precaution, even though the fields themselves have not been damaged. Iraq's Basra oil exports, which normally total around 3.2 million barrels per day, are constrained as shipping through the Strait of Hormuz becomes riskier. In Israel, offshore gas fields have temporarily suspended operations, reducing regional gas flows to Egypt and domestic markets. Across the Gulf, shipping lines have halted or rerouted tankers, compounding supply risk. Energy infrastructure and shipping lanes have become direct pressure points. Recent incidents have been reported near tanker routes in the Gulf of Oman. The broader maritime corridor linking the Gulf to the Red Sea and the Suez Canal remains under heightened threat. Countries like India, where gas is critical for fertilizers and city gas distribution, could face spot market exposure at significantly higher prices. For China, disruptions could increase reliance on more expensive cargoes from Australia or the United States, tightening the global LNG availability. Oil prices have jumped on supply fears, with traders pricing in a geopolitical risk premium. LNG spot prices have spiked on fears of delayed cargoes. Higher crude, gas, freight and insurance costs risk feeding directly into global inflation, even impacting fuel prices, electricity tariffs, manufacturing costs and food supply chains. For economies that were just stabilizing after prior energy shocks, this could complicate central bank policy and delay rate cut expectations. Iran has stated it will move ahead at all costs, but those costs are significant both economically and strategically. Iran produces roughly 3.4 million barrels per day and relies heavily on oil exports for revenue. Annual oil earnings are estimated between $50 and $70 billion, much of it flowing through the same Strait of Hormuz corridor now at risk. Any prolonged disruption or blockade would not only impact global supply, but it would also hit Iran's own export lifeline. Additional sanctions, tightened enforcement on shadow fleets, and military escalation could further strain state finances. So to sum it up, for the world, the risk is supply disruption and inflation. For energy importers like India and China, the risk is LNG price shocks and supply insecurity. And for Iran, the cost of escalation could include both military expenditure and billions in lost oil revenue.